Today, Beauty and the Beast. Market update for the 9th of October 2021. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. In today's show, we look at the latest from the markets as uncertainty continues to stall the halls. Many, though, are just admiring the beauty, exemplified by the Bitcoin 25% rise this week, while others worry about the beasts of inflation, faltering economic growth, higher energy prices, and the Chinese property sector, to name just a few. Wall Street closed sharply higher on Thursday on the back of the US Senate approving legislation to temporarily raise the federal government's debt limit and avoid the risk of a historic default. And stocks on Friday fell and Treasury yields gained after weak jobs data upended bets on the Federal Reserve's policy plans. The S&P 500 and NASDAQ 100 declined in turbulent trading as data showed employers added far fewer jobs than anticipated last month. While the report is unlikely to deter the Fed from announcing cutbacks to its bond buying next month, it may remove pressure for the central bank to raise interest rates any time soon. On the day, the S&P 500 fell 0.2%, the Dow Jones Industrial Average slipped 0.03%, and the NASDAQ Composite fell 0.51%. We don't think this derails the Fed from tapering, and with labour markets still somewhat slack, tightening is still a long way away, said Jay Barry, JP Morgan head of US dollar government bond strategy. As soon as you start thinking about asset tapering, it's really hard to not then think about what that means for the Fed funds rate and when that might start to increase. Commonwealth Bank of Australia currency strategist and international economist Kim Mundy told Bloomberg, "We do see scope that markets can start to price in a more aggressive Fed fund rate hike cycle." The 10-year Treasury yield rose to 1.6%. Gold eased a 1.5% advance, and US crude oil briefly topped $80 a barrel in New York for the first time since 2014. That said, the S&P 500 finished the week higher as stocks struggled for a direction on Friday. The session was marked by high volatility, with traders wading in to buy at the market lows. The volatility index was down, though, 3.94% to 1877. The buy the dip mentality rules the day, said JJ Kingham, chief market strategist at TD Ameritrade. That's really what it comes down to. The monthly jobs report was the second miss in a row, signalling weakness in the labour market just as the Fed is preparing to cut back stimulus. Non-farm payrolls increased 194,000 last month after an upwardly revised 366,000 gain in August, according to the latest Labour Department report. The unemployment rate fell to 4.8%, partly reflecting a decline in labour force participation among women. Meantime, average hourly earnings jumped. The drop in the jobless rate is important as it closes in on the Fed's target of 4% for full employment, which central bank chair Jerome Powell has repeatedly used as a gauge for any monetary tightening to come. The unemployment rate at 4.8% dropped from 5.9%, compared with a forecast for a decline to 5.1%. And average hourly earnings rose 0.6% last month, compared to August 0.4% increase, as firms increased wages to attract new workers amid a dearth of labour supply. US economy added just that 194,000 workers in September, as the jobs rate declined against a median projection for a 500,000 rise. The jobs figures risk not satisfying the Fed's substantial further progress criteria for labour market improvement, indicating the central bank could delay its plans to begin tapering asset purchases by the end of the year. Chair Jerome Powell said after last month's policy meeting that a reasonably good employment report for September would be needed to meet that test. Bottom line, I think the Fed would like it prudent to keep tapering on schedule and start the process next month, said Roberto Perli, a partner at Cornerstone Macro and a former Fed economist. But it will probably add caveats to the language to leave itself room to stop tapering if things get worse. Vaccine mandates, specifically in healthcare and education, put into place by employers and some states in recent weeks, would also be contributing to a churn in the labour market and adding to the hiring challenges. And the report showed employment in nursing and residential care dropped by 37,600. The biggest job losses in the report came from the government sector, while hiring in leisure and hospitality nearly doubled, suggesting the business outlook is strengthening, albeit slowly. The industries that have seen really strong gains are in some of those that were particularly impacted by the pandemic, so things like leisure and hospitality and retail, said Cara Murphy, Chief Investment Officer at Kelstra Holdings. The pandemic is still driving a lot of this kind of dislocation. The September payrolls have the smallest advance of the year after an up revision for the August figures, and with the turbulence it's unclear how the market is interpreting the data, said Mike Lograt, Managing Director of Investment Strategy at E-Trade Financial. On one hand, it's a knock to our economic recovery, he said. On the other, delaying Fed policy means the easy money era continues. The market will look back on this report as just a blip. Eric Green, Chief Investment Officer Equity at Penn Capital, told investment.com in an interview on Friday. There is a lot of noise in September that makes that report less reliable than normal. I'm sure we're going to see revisions. Gold swung almost $40 on the week, appearing at one stage headed for 1,800 US before returning to the mid-1,700s level as the underwhelming US jobs report for September and ramping bond yields combined to create volatility that did little ultimately for the yellow metals price. US gold futures, the most active contract for December, settled Friday's trade at 1,757.40 per ounce on the COMEX, down 0.1%, and for the week that was just $1 lower. It was kind of a roller coaster that was not, said Philip Strebel, precious metal strategist for Blue Line Futures in Chicago. The disappointment over the September jobs report sent gold flying, but the yield spike brought it back down to earth. Unless it goes back above $1,800, this action isn't a market that's promising on the upside, he added. The yield on the US 10-year Treasury note spiked to a June high of 1.615%. On that, high yields typically hurt non-yielding gold. After digesting the payrolls report, some gold investors quickly realized that the taper announcement is still happening in November, said Ed Moyer, analyst at online trading platform Honor. Pricing pressures are still elevated, and that could still dictate higher interest rates next year. Tech struggled to find its footing against rising yields and inflation, both of which sour the outlook on sectors like growth, with longer duration cash flows that become less attractive. Cyclical stocks, which move in tandem with the economy, fared better as energy and financials pushed higher. Energy was up by more than 2% as oil prices topped $80 a barrel for the first time since 2014, as concerns about tight supply persist despite recent efforts by the US and Russia to quell fears of an energy crunch. Crude prices pushed higher once more on Friday, heading for a seventh weekly gain, as doubts emerged over whether the US Energy Department was considering releasing oil from its country's strategic reserves. The potential for the US adding supply to the market had been floated on Thursday as a method of curbing oil prices. These have climbed to multi-year highs on the back of signs of improved fuel demand as economic activity rebounds. OPEC producers only gradually increase output, as well as fears that a cold winter will further strain gas supplies. Rising bank stocks, meanwhile, underpinned financials as investors look at the start of the quarterly earnings season for the return of loan growth at a time when Treasury yields continue to advance. Higher interest rates boost the return on interest that banks earn from their loan products. While the volatility is expected to continue into next week, the market is nearing a strong period for risk assets. There tends to be volatility in the first couple of weeks of October, then things start to calm down, Green said. The best performing sectors will be the more risky sectors, which in today's market are the cyclical stocks that have done well in the past year but have massively underperformed over the past 6 years. The Euro-US dollar was up 0.19% to 1.1573, and the US dollar future index was down 0.12% to 94.11. Before we move on, let's look in more detail at the S&P 500 50-day and 20-day moving average. Charters will say that when the price is above those moving averages in general and they're sloping upwards, that means the market is most likely going to continue to trend higher. When the price is sloping down and the price is below the moving average and the 20-day moving average is below the 50-day, that's just what the market is doing this week. This tells us that there's actually a mixed market signal. The market is struggling. As the saying goes, the trend is your friend, so it's always best to trade with the market trend for the chart time frame that you are following. And we've seen the S&P 500 break below the moving averages. It's now rallied up and it's hit its head under them as resistance. There is a series of lower highs and lower lows, which means we're in a short-term downtrend. But is this market about to start a new rally, or is it going to roll over and continue to move down? That, of course, is the big question. European stocks edged largely lower on Friday in tight trading ranges, with weak German trade data weighing ahead of the release of the key US jobs data. The monumental moves in European gas and energy prices ratcheted up to a new level on Wednesday. Prices were 40% higher at one point. However, the move reversed and prices finished down 10%, in part due to comments from Putin suggesting Russia could add incremental supply. The German DAX closed at 15,206, down 0.29% on the day, while the UK FTSE was up 0.25% to 7,095. The volume of German exports fell in August for the first time in 15 months, dropping by 1.2% compared with the 0.5% increase expected, as Europe's largest economy and main growth driver felt the effect of the global supply chain problems. That rounds off a disappointing week of August data from Europe's largest economy, with manufacturing orders and industrial production also recording sharp declines. Europe's record year for initial public offerings, or IPOs, is threatening to come to a juddering halt, as inflation fears and concerns over a property crisis in China have soured investors' appetite for new stock listings. Deal cancellations and postponements have started to hit the screens, with France's Evergrande Santé and Switzerland's Next pulling deals in the past week. Czech company Eurowag pushed through a reduced-size London IPO on Friday, but the trucking services group stocks fell 10% from its 150p offer price. Many companies that listed earlier in the year are trading below their IPO price, with the FTSE Renaissance IPO index for the Europe, Middle East and Africa region down 9.19% so far this year. Fear of inflation and rising interest rates, as well as uncertainty around China, have made many investors more cautious, said Christopher Lang, head of core equities in Europe for J. Safra Saracen. The Goldilocks environment we'd had for the last 12 months is over. The IPO market closely reflects investors' appetite for risk, and they tend to become more reluctant to commit large chunks of cash to a single company if the broader economic environment is showing signs of strain. Uncertainty over the fate of heavily indebted Chinese property company Evergrande and rising bond yields on the back of strong inflation numbers have hit stock markets globally. The MSCI World Index is down over 4% over the past month, and some of the indices follow that trend. We've had something of a buyer's strike, which is not a phrase I've had to use for a while, said one senior banker who managed IPOs in Europe. The market has turned quite viciously, and investors are reluctant to put money to work in IPOs unless they're a complete slam dunk. He said that apart from the deal cancellations, a number of IPOs that were being prepared behind the scenes are being postponed. A few high-profile IPOs are still heading for the market. For example, Volvo Cars in Sweden, a company that is hoping to tap into the huge appetite for electric vehicle makers and deliver what would be the biggest stock market listing in Europe in 2021. The disappointing US jobs release overshadowed the positive handover from Asia as Chinese mainland markets reopened after a week-long holiday, and the country's services sector made a return to growth in September after an August hit by COVID-19 lockdowns. Asia-Pacific stocks were mostly up on Friday morning, with China releasing better than expected economic data and concerns about the US debt ceiling easing. Investors kept an eye on Chinese markets, which reopened, of course, after the holidays as the shift focused back to the country's embattled property sector. The People's Bank of China Governor Yi Gang said the regulators will continue to curb monopolistic behaviour among internet platforms, as well as strengthen consumer and data protection. But the hit from China's energy crunch is starting to ripple through the globe, hurting everyone from Toyota Motor Corp to Australian sheep farmers and makers of cardboard boxes. The extreme electricity shortage caused by soaring prices of coal in the world's largest exporter is set to hurt China's own growth, and the knock-on impact to supply chains could crimp a global economy struggling to emerge from the pandemic. The timing couldn't be worse, with the shipping industry already facing congested supply lines that are delaying deliveries of clothes and toys for the year-end holidays. It also comes just as China starts its harvest season, raising concerns over sharply higher grocery bills. If the electricity shortages and production cuts continue, they could become yet another factor causing global supply-side problems, especially if they start to affect the production of export products, said Louis Couvis, senior Asia economist at Oxford Economics. Economists have already warned of slower growth in China. At Citigroup, a vulnerability index indicates that exporters of inputs to China's manufacturing sector, as well as commodities, are particularly at risk to a weakening Chinese economy. Neighbours like Taiwan and Korea are sensitive, as are metal exporters such as Australia and Chile, and key trading partners such as Germany are also somewhat exposed. As for global consumers, the question is whether manufacturers and retailers will absorb higher costs or will pass them along. This is looking like another stagflationary shock for manufacturing, not just for China but for the world, said Craig Botham, chief China economist at Pantheon Macroeconomics. The price increases by now are pretty broad-based, a consequence of China's deep involvement in global supply chains. Beijing has ordered coal mines to increase production and is scouring the world for energy supplies as it tries to stabilise the situation. The impact on the global economy will depend on how quickly those efforts bear fruit. Many Chinese factories reduced production for this week's Golden Week holiday, and economists are closely watching whether power shortages will return as they ramp up again. And briefly, on Evergrande, Bloomberg says Kirkland & Ellis and Marlius & Co. are working on contingency plans with offshore holders of China Evergrande Group's bonds who fear the struggling company may sell assets that they've counted on to back up their claims if the business collapses. The law firm of the New York-based investment bank are advising a group that so far includes 6 members holding $2.5 billion of Evergrande offshore bonds. They've been trying to engage with Evergrande and its advisors since September the 16th, sending letters asking for information about the company's situation and assurances that management won't sell offshore assets while a solution is being discussed. The offshore holders could be vulnerable because by some estimates they rank among the lowest priority for repayment if Evergrande becomes insolvent. The bondholders are acting amid signs that China will do everything it can to ring-fence Evergrande rather than organising a bailout for the teetering developer, whose distress has roiled global markets for weeks. This doesn't bode well for bondholders both onshore and abroad looking for some kind of government rescue. Their concerns have been fanned by reports that Evergrande has already failed to pay some of its debts. The Chinese real estate developer skipped interest due September 23rd and September 29th on some dollar-denominated notes and entered a grace period which gives the company a short time to make good on the debt before it becomes a formal default. Earlier this week, Bloomberg News reported that creditors didn't get repayment of a $260 million bond issued by Jumbo Fortune Enterprises. The note was guaranteed by China Evergrande Group and one of its units, creditors say, and it could be the firm's first major miss on maturing notes since regulators urged the developer to avoid a near-term default. Evergrande's offshore bondholders could wind up last in line when it comes to getting paid in a restructuring. Distressed debt veteran Michael Lowy said in a Bloomberg television interview on Friday that unfinished properties, unpaid contractors, home buyers, and the onshore creditors will all be prioritised ahead of offshore investors, and it may take many months for the developer to share its restructuring proposal given the complexity of the company. China's Shanghai Composite closed up 0.67% to 3,572. The Caixin Services Purchasing Managers Index for September, released on Friday, was at 53.4. And Hong Kong's Hang Seng Index was up 0.55% to 24,837. Sham's Nikkei 225 jumped 1.34% to 28,049, with data showing that Japanese household spending contracted by a higher than expected 3% year over year and 3.9% month over month in August. The adjusted current account was at 9.3 billion US dollars or 1.04 trillion Japanese yen, while the current account was 1.666 trillion Japanese yen. Something which has hardly been reported is that the Japanese central bank has stopped its QE program. In fact, there is a change in the wind, with the central planners now looking to ease up on the QE programs and will eventually raise interest rates, but it will take a long time. As Reuters recently discussed, after years of shock and awe stimulus, the Bank of Japan is quietly rolling back radical policies introduced by its bold chief Haruki Kuroda and pioneering controversial new measures that blur the lines between central banking and politics. Bearing in mind the status of the Federal Reserve and the European Central Bank, the third player holds about half of all government debt. But tapering started about 12 months ago, and the balance sheet has started to shrink, which begs the question, where to next? The BOG's dwindling monetary options means pushing the bank into schemes bordering on industrial policy, such as those designed to encourage bank sector consolidation and green finance. The most decisive and latest swing in policy direction, though not formally communicated, came in the BOJ's March meeting when it announced it would no longer commit to a fixed program of risky asset purchases, an inconspicuous sign it was slowing its monetary support. So this is one to watch, as it's a likely leading indicator of future central bank strategy. It's as if the BOJ is trying to prove itself by doing something new all the time, said a former BOJ deputy governor. What's becoming clear is that the BOJ can't affect and mould public mindset like jelly. Now in Australia, the Australian share market reversed 4 weeks of declines on Friday, with a strong performance from the energy sector amid a global shortage driving the gains. The ASX 200 rose 1.9% to 7,320 this week, the first time it's closed higher for the week in more than a month. The market's performance was particularly strong on Friday, with the benchmark index climbing 0.9%. The global energy crisis provided strong tailwinds for the market this week, with customers willing to pay whatever they could to secure a supply amid shortages of oil, gas and coal, buoying commodity prices. Woodside Petroleum firmed 6.7% to 25.34. Santos advanced 6% to 7.38. Origin Energy climbed 6.5% to 5.07. Oil Search rose 5.4% to 4.51, and Beach Energy added 1.8% to $1.45. The iron ore price was higher on Friday, with 62% fines up 4.08% to 123.08, and BHP was up 3% to 37.74, and Rio Tinto was up 4% to $100.40. The major banks also provided support to the market. Commonwealth Bank rose 4.4% to 104.45. NAB advanced 4.1% to 28.38. Westpac firmed 2.2% to 25.96, and ANZ climbed 1.9% to 27.96. Macquarie was up 0.9% to 182.28. With the global energy crisis putting pressure on inflation expectations, tech and healthcare were among the worst performing sectors on the market this week. Resmec dipped 3.7% to 35.22. Mesoblast declined 5.8% to 1.54, and Ramsay Healthcare closed the week 1.1% lower at 67.61. Xero slid 0.8% to 139.28, and Altium fell 2.1% to 34.01, while Afterpay Touch was up 1.96% to 122.99. EML Payments shares tumbled 15.7% to $3.16 after the Central Bank of Ireland said it wanted limits applied to EML's prepaid financial services business. EML said the demand could materially impact its operations in Ireland. And Sealink Travel Group shares dropped 14.6% to $7.49. The group wasn't able to secure the Melbourne Metropolitan Bus franchise contract from the Victorian government, losing to a bid from Kinetic. But the prospect of borders reopening down the track lifted some travel stocks, with Qantas up 0.18% to $5.59 as it announced direct flights from Australia to London via Darwin will commence soon. And so to crypto. Bitcoin had an incredible week of trading as its price reached levels not seen since the middle of May. This happened on the back of a considerable 25% increase in the past 7 days. In fact, it's been a green week across most of crypto land as positive sentiment and big gains returned to the market. Just earlier today, Bitcoin reached more than $56,000 US, something that we've not seen since the middle of May, shortly after the all-time high and right before the massive 50% crash. At the time of writing, it was sitting at 54,103. Some analysts believe that this move marks the completion of a bear trap and validates the continuation of this year's bull market, though further confirmation is still going to be required. It was up only as Bitcoin was trading at the start of the week at 47,000 and started increasing somewhere towards the middle of the week, tapering 50,000 on Tuesday. On Wednesday, the cryptocurrency went a massive 10% leg up and reached 55,000. And it's been consolidating within that range ever since. It did go up to 56,000 briefly, as I said. While the bulls celebrate, it's worth exploring potential reasons why these price movements have occurred. Firstly, there's a bunch of whale purchases. Being an asset with a maximum supply of just 21 million tokens, with a large percentage of the existing ones lost or in the hands of long-term holders, the price of Bitcoin could fluctuate hard whenever the so-called whales make substantial purchases or sales. Data presented by CryptoQuant provides a similar example. The purchase came just 24 hours ago, or just ahead of the $5,000 move. In it, someone or multiple parties accumulated $1.6 billion worth of Bitcoin via market orders in just 5 minutes. The short liquidations at that point were still relatively small, around $17 million, which makes it more likely that this was a whale purchase instead of cascade liquidations. And the second thing to think about is on-chain metrics. Arguably the most critical part of the health of the Bitcoin network is the hash rate, which is determined by the number of miners putting their computational devices to work on the blockchain. Interestingly, it's been previously linked to Bitcoin's price. Even the popular Bitcoin maximalist Max Kaiser previously asserted that when one goes up, the other tends to follow, and vice versa. The hash rate had reached an all-time high of nearly 200 e-hashes per second in May this year, shortly after the US dollar price of Bitcoin had charted its own record of 65,000 US. Following the fear, uncertainty, and doubt from Elon Musk and China, both went down hard. Bitcoin's price bottomed below 30,000 US. That's roughly a 60% decline, while the hash rate went down to 70 e-hashes per second, a similar drop. Now, though, both have been on the rebound. The hash rate is currently sitting around 130, according to BitInfo charts data. And the third reason is that the US, we've already seen what a reiteration of an already existing ban can do to the market. The world's most populated country has acted against the cryptocurrency industry for years, but every time it repeats the same ban or comes with a slightly different one, prices slump immediately. As such, it would be logical to assume that the opposite would also have a beneficial effect on the market. The world's largest economy by nominal GDP, the United States, has no intention to incorporate a ban on the industry. This was first asserted by Federal Chair Jerome Powell before the SEC boss Gary Gensler repeated it days later. Interestingly, Bitcoin indeed shot up by a few $1,000s following the encouraging words from Powell. Nevertheless, it's worth having in mind that the US still intends to implement regulations on the cryptocurrency space, but at least doesn't want to follow China's route. This happened on the back of seemingly positive news coming from the United States. The chairman of the Securities and Investment Commission, Gary Gensler, said that they have no plans of following China and banking Bitcoin. So Bitcoin managed to reclaim the coveted $1 trillion market cap mark and is in front of a serious supply area in the range of 55,000 to 58,000 US. Should overcome it, though. Many of the opinion that there's no considerable resistance until, say, $65,000. We'll see. One other factor to bear in mind is miners are hoarding their coins. Instead of selling their mining rewards to cover operating costs and to fund the expansion plans, mining firms are instead choosing to raise capital in other ways to avoid parting with their crypto. For example, Toronto-based Hut 8 recently filed to raise $150 million through a public offering, betting that the appreciation of the company's crypto asset would make up for the short-term price dip from diluting its shares. Other companies have started using their mining rewards as collateral to take out loans. Argo Blockchain recently finalized a deal with Galaxy Digital Holdings for a $25 million loan using Bitcoin as collateral. The past several months have been a unique opportunity for North American miners to expand. Following crackdowns on crypto mining in China, the Bitcoin hash rate plummeted, causing the mining difficulty to drop by 28%. As such, companies that continued mining throughout the summer were able to mine record amounts of Bitcoin and Ethereum. The unwillingness of miners to part with their crypto assets shows widespread bullish sentiment in the industry. Mining companies seem to have decided that the long-term upside potential of holding on to their Bitcoin and Ethereum is too great to pass up. Ethereum was at 3,587 at the time of writing. So you can decide whether we are looking at beauty or beast. For me, there are still questions to be answered, which suggest more volatility and uncertainty ahead. We will see. But here is one disturbing chart, the UN Index of Global Food Costs. It's at the highest it's been for a decade. Global food prices have already jumped to a decade high, and worries are mounting that the situation will worsen as China struggles to handle crops from corn to soya to peanuts and cotton. In recent weeks, several plants were forced to shut or reduce output to conserve electricity, such as soybean processors that crush beans to produce meat for animal feed and oil for cooking. Prices for fertilizer, one of the most important elements of agriculture, are skyrocketing, slamming farmers already buckling under the strain of rising costs. The processing industry is set to be more severely affected than staples such as grains and meat, Rabobank analysts wrote in a report this week. In the dairy sector, power cuts could disrupt the operation of milking machines, while pork suppliers will face pressure from tighter supply of cold storage. Stagflation, anyone? I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.